Fund and Airtel Business. Now, in studio is a man who is going to take us through the topic. It's called Godfrey Mwindaare. He is the chief executive of the Acumen Fund West Africa. Kojo, what else can you tell us about Godfrey?
Yes, Godfrey is the West Africa director of Acumen, and this is what Acumen does. Acumen raises charitable donations to invest in companies, leaders, and ideas that are changing the way the world tackles poverty. Now, as West Africa director for Acumen, Godfrey is responsible for all West Africa related investments, operations, and business development activities. Additionally, as part of the portfolio leadership team, he is jointly responsible for the global portfolio of Acumen, with special focus on the new West Africa investments. Godfrey has worked in various industries from banking to mining, and he's a board member of the Millennium Promise UK Pagatech in Nigeria, Isoko Limited, Green Africa Power, also in the UK, which is funded by the UK government for renewable energy in Africa. And he's a product of the Kwame Nkrumah University of Science and Technology.
I knew you would say that.
Yes, where he did mining engineering, and he has an MBA from the University of Hull Business School in the UK.
I knew you bring the KNUST part. Godfrey, it's good to have you on the show. Good morning.
Yeah, thank you very much, Bernard.
As you know, we have lots of small businesses listening to us. We're focusing on entrepreneurship this week, so we're trying for you to give them a sense of where they can get investment, so they can move their businesses to the next level. So what do you have for us today?
Yeah, Bernard, in terms of the topic, I guess before let my listeners understand the different sources of funding. Basically, there are two types of funding. We have debt funding and we have equity funding. And with debt, as we all know, you have to pay the interest with the principal. But with equity, the people who invest are shareholders in the company. But for the target market that we are talking about, equity funding is the suitable product for companies to grow. And depending on the type of funding that you select will also depend on the life cycle stage of the company that you are in. We often say that a company goes through from blueprint to scale. And depending where you are within that blueprint to scale, then you have to choose the type of funding that you need. And particularly for early stage investments, for startups, we often call them and for the pioneer phase, you should be looking for equity funding. In the pioneer phase, what do we need by that? It means that your product is still being developed, it's still being tested. Your revenue model is not yet proven. And maybe you are still figuring out your distribution model. And for that matter, it will be suicidal for you to go and pick debt that you will be saddled with principal repayment as well as interest. I will look at it in a couple of ways. I would like the promoter to understand the stage of their business and then try to choose an investor. And from the promoter's point of view, what should you be looking for in an investor? I think because it's an early stage investment, you should be looking for an investor who is prepared to take the risk with you. Sometimes you will bring in somebody who has invested in you but does not have the appetite to take the risk with you. You should also be looking for somebody who is a patient investor and is able to support you throughout the life cycle of the company as you grow. And also you have to look for somebody who has deep pockets, because maybe the person who will seed you, I can tell you in my experience that there will be subsequent rounds for your investment as you scale up. And you will need somebody who has deep pocket to be able to support you throughout that journey and bring in other new investors. You should also be looking for somebody who will help you troubleshoot some of the challenges that you will be facing. And there are lots of challenges for startup companies or early stage companies. So you should look for an investor who has the capacity to provide you with technical assistance or capacity building opportunities in your company. Last but not the least, look for somebody whose values are aligned to the values of the company and promoter, because value misalignment has been seen to be one of the greatest challenges for companies' inability to scale. And of course, look for people who have the ecosystem to bring in other people who can provide services for you pro bono. What do I mean by that? As an entrepreneur, you are only good at the area that you are in, but you may need somebody to help you with your IT, you look for an investor who has that network to bring somebody who will help you with your IT, financial control issues, and so on. But that said, Bernard, it will be a foolhardy not to mention that, yes, from the promoter's point of view, look for these signs. But of course, the investors too are looking to invest in businesses, and it will be good for me to just go through some of the things that the investors are looking for. For you, the promoter, to come into the market and you're looking for funding, for you to be attractive to an investor, these are some of the things that an investor will be looking for. Most of the times, a promoter has a business idea that is in their head. An investor wants you to put your idea or vision on paper in the form of a business plan. And this business plan, you should be able to show an understanding of the market that you're in, the competitors that you will be dealing with, the risk that the business will face, and have mitigation plans in place. But also key to this is that understand what are the key value drivers of the business. The investor would like you to demonstrate this knowledge so that they are confident that you have really researched the market that you are into. In addition to understanding your market, you should be modest in your forecast. Sometimes we see forecasts that promoters bring, and they're just wild forecasts. And we have a way of testing to know if these forecasts are realistic or not. Another aspect that we look for is that an entrepreneur should be able to demonstrate that he understands the unit economics of the business. And this is critical. For instance, if you want to build a chain of clinics, we want you to understand the unit economics, which means that for each clinic, let us be sure to show us how many patients you will need to break even, and how many patients you will need to make profit, and what price points all of these services we are providing would you will be charging. So it's important for you to understand the unit economics before you begin to scale, because entrepreneurs are often very ambitious and they have tackled one unit and they haven't finished it and demonstrated the profitability of that unit, and they move on to do another thing. You need to be transparent and share information, because decisions are made on the basis of information. And we have seen sometimes where entrepreneurs are keeping information to their chest, and it's not a good position to be in. When the investor gets to see that you are keeping information and not disclosing information, it's not a good position to be in. And we are looking for people who are passionate about the idea. Passion is everything. And we will want you to have passion alone is not sufficient. We want to see that you have your skin in the game. And particularly, I think the investing space is evolving. And we have had a new category of investors that we call impact investors or social impact investors. So for those of you who are into that space, make sure that you understand the social impact of your project. And there are lots of these funds available to support your business. I think that, you know, often in the investment balance, particularly in the early stage, we often say that we are backing the jockey and not the horse. So you, the jockey who is the promoter, be sure that you can gel with the investor, that you are transparent, and the investor is confident that this jockey will be able to win the race for us. But let him also conclude by saying that there are certain breakers, because usually it's not just about having a relationship with an investor. You go through the whole process, and there are some deal breakers, common deal breakers that do not make the investment materialize. And it will be good for me to share that with listeners to understand some of the key deal breakers that we see as we make transactions in this space. The key deal breaker is that the investor wants to eat their cake and have it. And what do I mean by that? They want to share the risk with you, and they don't want to share the upside. It's a risk-reward trade-off, and nobody will take risk, and there's no potential for upside. So when you demonstrate that you are prepared to share risk and you not share the upside, it's a sign of a failure in your relationship. The second greatest or frequent deal breaker is always about valuation. Valuation of the company. Most of the time, if it's in the startup phase, you don't have any evidence of cash flow. But these investors, are promoters, are so bullish about their companies that the valuation that they will quote for you to invest is in the skies. So valuation can be a key deal breaker in most of these transactions that we have seen. So be realistic with your valuation, particularly if you don't have cash flow. It's very difficult for you to put a figure as to the value of the company. Even where you have cash flow, in the pioneer phase, we often see that the cash flows are not, they are volatile and not consistent. So, and we often do not have comparable transactions in the market for us to take reference from. The third deal breaker is always disagreement about use of funds, because we have invested in a company and you want them to use it to build the capacity of the company, invest in capital assets, but the promoter wants to use it to buy luxury cars in order to for self fulfillment and aggrandizement. And that's always a difficult area to negotiate, because we want you to use the money to invest in the growth of the company. The fourth common deal breaker in these type of transactions is corporate governance. Lack of good corporate governance, and some of the signposts of poor corporate governance is when you have related persons employed in the company and you don't know what job they are doing. It could be spouses, it could be uncles, it could be sons. So it's one of the key things that we have seen that often makes a transaction stall. And then you may have a lack of or a non-functioning board. Many people see a board as a compliance thing. They just call their friends or relatives to sit on the board, but they don't see it as a value-adding exercise. They just see it as compliance. Let me call Bernard to sit on the company, and they never things and go through the strategy and have a plan in place. That can be a deal breaker. And another deal breaker is keeping two books, one for the taxman and one for the banker. When you do that, it's quite because they want to minimize taxes, so they will show financials to the taxman, and then because you are coming in to invest, they want to show that this business is profitable. They show you another set of financials that look quite different from that they've shown the taxman. And this type of thing, in actual, it's not a good practice, because it just shows that you, the entrepreneur or the promoter, can be trusted. And last but not the least, I think lack of accountability within management. The CEO or the managing director feels that I can dip into the purse without actually having records showing that I pulled the draw 10,000 Ghana cedis for personal staff. And these are some of the challenges that we face and so on. And as an early stage company, as a startup, as a pioneer company, you have so many things that you need to do, and you may not have the required expertise, and you need to bring an investor in who can handhold you to go through the whole life from the early startup to growth to maturity. So I'll end here, and then if there are any questions that people may have, I'll be glad to answer them.
How to attract investment for your business, and Godfrey Mwindaare, our guest, has given us a very beautiful outline where he says we should know which stage our business is in. I'll ask you to elaborate a bit on the phases, because you said there's the pioneer or early phase, which thrives on equity funding and not debt. Then there should be other phases for small business. So apart from the pioneer phase, what other phase would you have?
Literally, if we look at a company life cycle, you have the startup, the early stage, the growth stage, and the mature stage. But from the startup to the early phase, that's what we call the pioneer phase. And like I said, in this pioneer phase, your product is probably not finalized. You don't have a proven revenue model, or you are even figuring out your distribution model. So in essence, what characterizes the pioneer phase is that you don't have cash flow. So for you to go and go to the bank and take debt, that you will have to pay mandatory interest and principal. That is suicidal for that type of company. So when we say the pioneer phase is the startup early stage before you get into the growth, which is the scaling up phase. And in the growth stages, you may have consistent cash flows, and you can use debt to complement equity to grow your business then into the matured phase where your market share is pretty
I'm asking this because
large.
a lot of times when you ask small business owners or fresh entrepreneurs what their number one problem is, they'll say lack of access to credit. It appears that is mistaken from the explanation you've given. For businesses in the pioneer phase, what they need is not necessarily credit as money lending to you, but possibly equity, which possibly even guide you and not just give you money to spend on expenses.
Yeah, indeed. And we've seen companies or promoters who have brilliant ideas, and they've had to suffer because they took the wrong kind of money, which is bank credit. And for that matter, they switch off the phones when the bank is calling them because your business is not churning in cash flow, and the bankers are running after you for their money. So I will say, in terms of stages, if you are in the startup phase, use your own money to prove the business model to a certain extent. Use your friends, and then you have the venture capital investors and early stage investors, impact investors like Acumen, to come and look at your business, and if there is innovative and there's the opportunity for you to sell your services, they will support you. But in that phase, debt is not the
answer.
Yeah.
So here I am in the phase. My product is not possibly tested. It's a good idea, but revenue is not proven. Distribution not well sorted. How do I proceed to value my business? Because I am coming to you and you are offering me equity in the business. So I'm offering you equity in the business. I'm not a professional business valuer. I'm not an accountant. I just have a great idea which I've tried on a very minimal scale and it's worked. Does this not predispose the promoter to being exploited? Because the strength and the knowledge and the power is on the side of the investor.
I think that's a misconception, or it depends on the type of investor that is in there. For us in Acumen, we always say we are an ethical investor, and the key thing that we do is that we provide smart money, which means that when we invest in you, we try to help you in terms of capacity building, as well as trying to give technical assistance and so on. And like you said, yes, if we cannot agree a figure today, we can agree to have evaluation in 3 years' time based on certain historical numbers. So we could say that, okay, today, Bernard, if I were to give you $1 million into your business, I think the business is worth $1 million, which means I will own 100% of the company. We don't do that. We want the promoter to have a skin in the game. And usually we take a minority position so that the entrepreneur will be motivated to make sure that this business succeeds. So what we could do is that we could give you an instrument, but with a convertibility option in year 3 or year 4, when you have built a revenue stream, where we could say that, okay, in year 4, we will now convert, and the valuation we will use is a multiple of revenue. So if we really demonstrate that the revenue, if your revenue then in year 3 is about $3 million times 2, that's $6 million, and we are giving you $1 million, then you can see what the post money valuation will be in the business and the percentages that we will get. So we really will not want to, because we don't run the business. We are investors, and we want the promoter to run the business, and we want the promoter to wake up every day wanting the business to succeed. Why would you work for a business that you have no skin in the game? So
that's a fair point. But I noticed that a lot of venture capitalists and some people who invest in business try to bring in a certain discipline into the way the business is run, and they typically would ask that certain positions be occupied by their people. How do we go about that? So here I am with a technology company, great idea. Somebody wants to give me money for 30% of the business, yet they also want a certain degree of control. How should the promoter assess these offers for control and management? How should he view them?
I think usually the promoter should come from a point of view that this investor is in there to help me grow the business, and when the investor is leaving, if the share of his the percentage share of the company when he's leaving is higher because the size of the pie is bigger. It should not be confrontational. when we go in our due diligence and whatever, you talk about a technology company. Maybe you are an IT wizard and whatever, you can program and all of that, but you don't have financial background to be able to do record keeping and so on and so forth. You don't have marketing expertise to take your product to the market. You don't know anything about distribution and so on. So we try to identify the strengths and weaknesses of the current structure in terms of board and management, and we do infills. It's not like we will come in and bring in somebody by virtue that is Acumen investing and the fellow cannot add value to your business. So I would like entrepreneurs to see it as a value add services that the investor is bringing in, than approaching it as, look, they are bringing in a big brother to watch me. If you are transparent and you have nothing to hide, I will tell you that most investors, the infills that they will bring in is meant to strengthen your company. So take it from stage 1 to 2 to 3 and to 4, and in the end, everybody is a win-win for both parties. So it shouldn't be seen. We have invested $7.8 million already in West Africa, and in the companies that we are in, we are not just in there because we want to be big brother. We are adding skill set that is adding value to the company. So depending on the sector that we are in, we look at what is needed. We even help the investee company on subsequent rounds to open up the network of investors. We may be the early investors. Then the next time you want to raise funding, we open up our network and bring in new people to support your growth. And that's the kind of value add that you should be looking for, like I said, from an investor, and make sure that there's value alignment between you and the investor. If there's no value alignment and chemistry between the two of you, then it's a marriage that is bound to fail.
Must the promoter or the entrepreneur have expertise in the area of business? Let me give you an example. Some of my friends are into tilapia business. They are not fisher folk, but they have bought portions of a certain lake and they've gotten professional fishermen or fish people to manage the farms for them. Some of my friends are into manufacturing of shoes. They are not shoemakers, but they get people who can create shoes based on designs that they produce, and then they sell the shoes. Some are into clothes business. They don't even know how to sew. How do investors see these kinds of promoters where his strength is not being a tailor or a shoemaker or being a farmer, but his strength is in the design or having a bigger picture of how the business will work? Do you worry about such promoters, and do you prefer, for example, an engineer to run an IT startup than somebody who just has a good idea?
No, we're not averse to a promoter who does not have the whole integrated knowledge about the industry. Like you said, the fellow is the designer and not a tailor. So you just design, there will be cutters who will cut and people will sell. The key assessment that we make is this product needed in the market? At the moment, we have invested in agricultural companies that the promoters are city bankers from the city of London, and they just saw the opportunity in rice farming, and they've come. But we need to be sure that there is a market for rice farming. And at the same time, within the management team, we have agronomists, we have infrastructure developers who can build the canals for irrigation and so on. I'll be surprised if an entrepreneur who has opened up a business would have all the core skills to make the business succeed. But perfect what you know, bring in the necessary skill set within the whole value chain or the core skills that is needed for the business to succeed. It's not a risk that we are wary to take. It's something that is natural because no person is a jack of everything.
Now let's talk a bit about, elaborate on what investors look for. You said, number one, the promoter must be modest in their forecast. And listen, I'm using promoter to mean the person who runs the business. So that's the entrepreneur, the person who has the idea, who's starting up and who's looking for somebody to support him. They must demonstrate understanding of the unit economics of the business. And this is even before you scale up. And then they must be transparent and share information. Elaborate a bit on these. So you want me, the promoter of the business, to be modest in my forecast, which means I should be realistic. I shouldn't give you too much reason for optimism. So I shouldn't paint a better picture Now, if I'm not too optimistic about my business, why should you come and join me?
Okay, Bernard, for that particular point, yes, I'm just throwing caution out there because for us investors, there are ways that we can interrogate your numbers and be able to tell you that your numbers are not realistic. So yes, you need to be optimistic about your business, but temper it with caution and modesty. The key being when you bring your financials to me and I interrogate it and probably cut it by 90%, what does that mean? You basically telling me you don't understand your business. That's the first red flag. If you don't understand your business, that's why you will say, I'm going to sell 1,000,000 units in year one. When you are a startup and probably you have to build the distribution network like a consumer company, and you starting up, you don't have the capital. So that's why I mean by, if you don't do that and we interrogate the numbers and we think they are not realistic, it points to the fact that you don't understand your business. That's the key point I wanted to make with that comment.
Send us your comments on 054-998-6996. If you have a business that you started and you're looking for investment, have all your questions been answered? Do you now understand why equity may be better than just credit or a loan, as many people call? Send us your thoughts. My guest is Godfrey Mwindaare from the Acumen Fund. You made a very interesting point that we are backing the jockey and not the horse. Please elaborate because it sounds interesting.
Yeah, what I mean by that is that you, in the startup and early stage, like I said, the business is not yet proven. So we don't know the nature of the horse. But you are standing there as the jockey who is going to ride the horse. So I look at you to see, is this person fit as a jockey to be able to ride this horse that we really are not conversant with? We really don't understand if this horse will last the race. So it's all about you who has the idea, because most of the times it's just an idea. You don't even have cash flows to show for it. So I'm not going to use cash flow as the main basis for making my decision. I am trying to analyze, looking into the future, if there is a market for this product, if this jockey is somebody I can rely on and put a bet on before I put up the investment. It's just the nature of the business because you have nothing to show. You haven't won a race yet. But I'm making that bet on you that I think, looking at the way your demeanor and the way you look, I think that this is a very good jockey, and if he is given this horse, will be able to finish the race and win the medal.
Just a general question. I notice in my work a lot of IT entrepreneurs, yet I get the sense that people like Acumen Fund and others are more interested in simpler areas of business like agriculture, aquaculture. Lots of young people from university are developing applications. They are creating things with the computer that they feel is the future. What is the attitude of investors to IT technology in this country specifically, or in West Africa? Is there a trepidation that it may not be as proven an area of investment as the literature may suggest?
Yeah, it may seem so, but we have a different view of technology-based companies. We are actually looking at technology-based companies because we think that for us to change the way the world tackles poverty, things got to be innovative. And what's the current innovation? The current innovation is about technology. And like you may look at some of our portfolio companies, we have invested in technology that is trying to bridge the gap between more endowed farmers and rural farmers. Like I said, we have the company where Isoko that we have invested in. We've invested in a company called Paga in Nigeria. We are trying to use technology, which is the mobile phone, to create financial inclusion in Nigeria, where financial penetration is 30%. So yes, the way we look at technology is, how do we use technology to bridge the gap between the endowed and the less endowed? So for me, in trying to build my pipeline, I'm looking for how can we use technology to improve access and quality to healthcare? How can we use technology to improve access and quality to education, so we can break the gap between a less endowed school and well-endowed schools. Those opportunities we are looking at. So we are not averse to that. We think that technology is the way forward in trying to build inclusive society where we have a shared growth among the citizenry, and the promoter must come with an idea that helps the different sectors that we are interested in.
We have some questions on text line.
Well, this one says, I want to set up a private practice at Kaswa. Please tell me how to get the capital finance for the project. I've acquired the land already from Dr. Adolfo at Kolebu.
So this is a doctor who wants to set up
yes,
a private
the land
medical
already.
practice in Kaswa. And he wants to know what?
He wants to know how to get the capital finance for the project, and he has the land already.
I think what I'll tell Dr. Adolfo is that he should look for the impact investors in this country. He should have a business plan. He has this land. What sort of practice is he trying to set up? I don't know. Is this something to do with mother or child health, or is it about diagnostics and so on and so forth? He needs to synthesize what it is and how that is relevant to his experience, and therefore be able to outline what the market potential is. And there are investors who would like to look at this opportunity.
So he needs a business plan.
He needs a business plan. He should be focused on which target segment of the market he's trying to handle. Is it about preventative medicine, or is it about creative medicine? Is it about women health? Is it about child health?
Is it dentistry?
Indeed. So he needs to synthesize what it is and why he thinks there's a potential for that market.
But you consider a medical practice an impact investment in a sense that it is in an area of health.
Indeed, at the moment we're actually looking at a pipeline transaction, but the key thing, as you understand, is that any investment that we do must benefit the bottom of the pyramid. If we put up a health facility in airport residential, Acumen will not be able to invest in that. But if we put up a health facility in one of the remotest areas with the necessary equipment and so on and so forth, and you are able to demonstrate that this is a financially viable business and you are providing critical services to these people who hitherto had to probably travel days to access the next health center. This is something that we're looking for. But like I said, many promoters should understand what they need to do, then research the different type of investors that are in place and narrow down their search to those specific people. Because we are impact investors focusing on the bottom of the pyramid, the key question is, whatever services we are producing, how does that affect the poor? If that affects the poor and it's in agriculture, healthcare, education, water and sanitation, and renewable energy, then you can come to impact investors like us.
Well, this one says, how can we get in touch with Godfrey for further inquiries and directions? And this message is from Mercy. She says, how do I find investors? Who will invest in my business and where are they? Now, this one says, what is the minimum amount of funds that can be accessed from Acumen? This one says, great discussion. I agree with your guest that when you start a small business, you don't go in for loans to start from Etonam. Now, this one says, if you are entering an industry where competition is so high, what should the promoter do to convince the investor he or she needs to trust you? And it's from Kofi Owusu. And this one says, will the investor still be willing to invest if the promoter is not able to show cash flow for the business?
Let's take it one by one. I like the last but one question. Just repeat that one.
If you are in an industry competitive, how does the promoter convince the investor to trust you?
So let's deal with that one first. This is from Kofi Owusu.
Yeah, I guess like he said, it's an industry that is competitive. He needs to show me what is his differentiation strategy. Is it a different product that is superior to the rest of the competitors, or is a low-cost product where it's affordable to people? He needs to show, he already knows that the industry is competitive, so you need to show something different. You need to demonstrate that your product is unique, or is less costly compared to the competitors, or probably the way you will distribute to your target customers will be different from what the competition is doing. You need to synthesize that, and the investor will be looking at all of these things to say the competition in the market is very high, but I'm prepared to take this because the product is unique, it's different, it has a certain value add than what the competition is, or the cost is very low, and for that matter, for the same value, people will pay less, or the
so it's a question of proving. It's not
yes,
just about how crowded
yes,
the market is.
Yes.
There was a previous question I wanted you to address,
and it was about the investor. It says, will the investor still be willing to invest if the promoter is not able to show cash flow for the business?
Yes, this is what I said, that you need to look at the type of investor. There are investors who will invest in ideas. There are also investors who will invest even if the cash flows are not there and they believe that the product has a traction, or it has a appeal in the market. So you don't need to show cash flow before somebody will invest in your idea.
This message reads, Bernard, I'm a promoter for a fish farming business, and an investor has expressed interest in providing equity funding. I'm providing the land, time, and management skills whilst he provides funding. When and how do we set up a shareholding structure?
If he's an equity investor, before he will disburse his money, the shareholder structure will have to be dealt with. And like I said, most of the times, in this kind of case, you don't have any cash flow. Valuation will be an issue, but you always have a derivative of equity instruments. Like I said, you postpone when the conversion will be done, so it's a preferred convertible equity where a coupon will be accumulated to the conversion date, and the company will have some traction of cash flow. Then you will use that historical cash flow to arrive at a shareholding structure. But it has to be the first time that you are negotiating with this investor. The shareholding structure will have to be outlined, though they may not have converted yet, or the valuation hasn't been agreed, but they will want to have board members on the company to narrow a certain skill gap. So the risk involved is that as the investor, if your ideas didn't gain traction, we all lose our money. You don't have to pay any interest and all of that. But if we are going to give you equity debt, we often call ourselves patient investors, and we can give you long-term debt and so on and so forth. So if you are not able to pay the interest and the principal, and there's any security that has to be realized to liquidate the debt position, we will do that.
A few people wanted to know how to contact you. I don't know if you have a web address or some way in which they could get in touch with you. So that's for you to think about. You obviously are not averse to that, are you?
No. I think our website is there. There's lots of information on our website. It's www.acumen.org. And our office is in East Legon by the ANC Mall, second floor above the coffee lounge. So if you come there, we have our portfolio managers who can speak to you, review your business plan to see if you fit within the criteria that we're looking for, you are in the sector that we're looking for. And I think if you go to our website to go through the portfolio of companies we've invested in, we've invested about $83 million globally in 75 companies, from agriculture to renewable energy, solar companies to husk gasification plants to sanitation and so on. That should give you a clue as to the type of businesses that we're looking for and what the theory of change is for us to invest in the business.
Godfrey Mwindaare from the Acumen Fund. Acumen is spelled ACUMEN, for those of you who want to check out the website. Thank you so much for these insightful thoughts on how to attract funding for your business. This segment of the show was brought to you by the Students Loan Trust Fund. Now, we've taken over from the SNIC the responsibility